China's government has reportedly ordered its domestic airlines to stop accepting deliveries of Boeing jets and to halt purchases of aircraft parts from the U.S.
And Karen, Boeing may be caught in the crosshairs of the U.S.-China trade war. Bloomberg News has learned China has ordered its airlines not to take any further deliveries of Boeing jets.
President Trump, and speaking of China, the country has reportedly ordered Chinese airlines to stop taking deliveries of Boeing jets amidst trade tensions with the U.S.
Trade tensions between the U.S. and China have now reached the skies, spilling over into the aviation industry in a way that's hard to ignore. At the center of this turbulence is Boeing, which has found itself under intense pressure following a major decision by China's Civil Aviation Administration to halt all deliveries of Boeing aircraft. This announcement sent shockwaves through the market, triggering a sharp decline in Boeing's stock and revealing the vast scope and lasting consequences of this geopolitical standoff. What's at stake isn't just one company or industry. It's an intricate web of global supply chains, millions of jobs, and billions of dollars in economic activity. So what do the numbers tell us about the scale of this aviation fallout? Let's break it down and examine how strained the U.S.-China aviation relationship has become using hard data for clarity. As of late last year, Boeing's global backlog included roughly 4,500 aircraft orders. Of these, more than 1,200 were either confirmed or potential orders tied to Chinese airlines or leasing firms. That figure represents approximately 26% to 28% of Boeing's total order book. The list price for wide-body aircraft averages around $300 million, while narrow-body jets like the 737 typically list for about $110 million. While actual transaction values tend to be lower after negotiations, analysts stress that Chinese orders still account for a massive $10 billion slice of Boeing's yearly revenue. When long-term agreements for spare parts and ongoing maintenance are factored in, the revenue at risk could rise even further. If China is now freezing all future deliveries, especially those scheduled for the near term, it could jeopardize between $10 and $12 billion in projected income for Boeing. Markets reacted quickly. The company's stock price plummeted by nearly 10% within days of the announcement. But it's not just the current sales freeze spooking investors. Analysts attribute the sharp drop to growing concerns over potential future retaliation from Beijing. There are fears that if China continues down this path, it could shift its aviation preferences toward Airbus or accelerate domestic aircraft production, permanently diminishing Boeing's market share. In fact, according to 2024 data, China's combined purchases from both Boeing and Airbus amounted to roughly 14.5 billion tons of aircraft. Should Beijing increase its Airbus orders or double down on homegrown options like COMAC, Boeing could see its annual revenue from China shrink to just $5 to $6 billion. That kind of drop could translate into a $40 to $50 billion hit to Boeing's market value over time, a scenario that's already causing alarm among shareholders. The ripple effects of this decision extend well beyond Boeing and deeply into the U.S. economy. Aviation exports are a major factor in narrowing America's current account deficit. U.S. exports of aircraft and aviation equipment total roughly $130 to $140 billion each year, with commercial airliners and related services representing a huge chunk, most of which comes from Boeing. China accounts for roughly 15% to 18% of this export segment. Losing that share could reduce the U.S. export balance by billions annually. Furthermore, Boeing's supply chain touches nearly every state in the U.S., from engine components and avionics to cabin seating and landing gear, involving thousands of subcontractors and suppliers. If deliveries to China grind to a halt, job losses across this vast network are a real risk. Some estimates now suggest that engine part suppliers alone could lay off between 5,000 and 10,000 workers by the end of 2025. However, shifting away from Boeing presents logistical challenges for China as well. While Beijing is looking to strengthen ties with Airbus and boost production of homegrown aircraft like the C919 and CR929 from COMAC, replacing Boeing's wide-body jets in the short term won't be easy. Chinese carriers rely heavily on Boeing models such as the 777, 787, and 737 MAX for international routes. Transitioning to Airbus alternatives will require extensive retraining, new maintenance protocols, and sourcing spare parts, all of which involve substantial costs and long lead times. Moreover, it remains uncertain how quickly COMAC can scale production to meet demand. In short, Beijing's move will cause some temporary setbacks on its own side, too. But the calculus seems to be, we'll take a hit, but America will suffer more. It's a classic lose-lose strategy, a hallmark of high-stakes trade wars where neither party is ready to blink first. Looking at the bigger picture, the U.S. has already imposed tariffs ranging from 25% to 50% on various Chinese tech and industrial products, and has even floated 100% tariffs on some strategic items. In response, China has retaliated by restricting imports of American agricultural goods, energy products, and now, crucially, commercial aircraft. This latest move essentially freezes all new civilian aircraft purchases. Previous Boeing deals in China carried a total potential value of around $150 to $160 billion. Should that volume shift toward Airbus or other manufacturers, Boeing could face long-term damage to its revenue streams. In the short term, market volatility has already erased $15 to $20 billion from Boeing's valuation over the past week. This comes on top of the $20 billion in damages the company has absorbed in recent years from the 737 MAX crisis during the pandemic. Now, it's facing another financial storm. Some analyst projections indicate that if China maintains this stance for 6 to 12 months, Boeing's revenue from aircraft deliveries could drop by as much as 20 to 25%. Boeing employs around 140,000 people globally, with roughly 30,000 dedicated specifically to commercial aircraft production. A prolonged suspension of deliveries to one of its biggest markets could have serious implications not just for Boeing, but for the broader aerospace sector and U.S. manufacturing as a whole. A single percentage point decline in Boeing's profit margin could put thousands of jobs at risk. That's why some experts argue that economic protectionism may ultimately backfire, posing a serious threat not just to policy goals, but to American workers themselves. In recent press briefings, President Trump placed the blame squarely on Beijing, claiming that China walked away from the Boeing deal and accusing the country of damaging the U.S. economy through unfair tariffs and currency manipulation. These remarks signal that the White House has no intention of retreating. But trade analysts caution that if tensions continue unchecked, the U.S.-China partnership in aviation could suffer irreversible damage. Speculation is already mounting that Airbus might announce a new wave of orders from China in a press event slated for late April. If Airbus steps in with a fresh order of 100 to 150 aircraft, it could wipe out Boeing's remaining foothold in the Chinese market. Boeing executives say such a development would mark their worst-case scenario. According to figures circulated in Chinese media, Boeing's aircraft sales to China over the past 5 years have exceeded $50 billion in total value. Chinese airlines have outlined plans to purchase more than 500 new jets over the next decade, and Boeing has been involved in talks for the bulk of those orders. Each aircraft delivery typically generates between $100 million and $300 million in revenue, rising to $500 million when service and spare parts agreements are included. If Beijing decides to pull out of this purchasing roadmap, it could leave a massive shortfall of hundreds of aircraft in Boeing's future order books. Although alternative programs like Airbus and the CR929, a joint venture between Russia and China, are under development, analysts note that they won't be able to fill that void in the near term. That's why many believe China's move is less about immediate gains and more about sending a message, even if it imposes short-term costs on its own carriers. Boeing, however, views the decision as political retaliation, plain and simple. Lobbyists for the company have reportedly warned U.S. lawmakers that this trade war won't just impact the next 10 years, it could damage Boeing's ability to do business in China for the next 3 decades. Some members of Congress have voiced support for revisiting tariff policy to safeguard Boeing's access to the Chinese market. But the Trump administration has taken a firm stance, declaring the trade approach as part of a larger strategy with no room for concessions. In essence, Boeing has become collateral damage in a much larger political conflict. The company's 2024 financial reports showed $7.4 billion in revenue from Chinese deliveries. For 2025, that figure was projected to grow to between $9 billion and $10 billion. Now that forecast is in jeopardy of collapsing entirely. Industry experts warn this situation could spill over into other corners of the U.S. economy. If China escalates its retaliatory measures beyond Boeing, targeting sectors like chemicals, agriculture, or semiconductors, then much more U.S. trade could be placed at risk. Should Washington respond with additional sanctions, it may trigger a second, even more disruptive phase of the trade war. That could shrink export volumes on both sides and raise the threat of a global economic slowdown. For now, Boeing is the most visible symbol of these mounting tensions. But this could just be the beginning. Insiders caution that similar retaliatory actions could emerge in key areas such as agriculture and technology. If that happens, it could drive up unemployment in the U.S. and severely undermine investor confidence, setting off a wave of volatility in global markets. Without a doubt, all eyes are also on Europe's aerospace giant, Airbus, in the midst of this growing turmoil. We're not aiming to capitalize on trade disputes, but if the demand comes, we'll do what's necessary, Airbus representatives have stated. The company's shares have shown a modest upward trend, likely reflecting investor expectations that China may increasingly shift toward Airbus for its aviation needs. Should a formal agreement between Airbus and China be announced, it would strike yet another blow to Boeing. Regardless of whether this happens immediately or not, the current standoff between Boeing and China is already setting the stage for a significant fracture in the civil aviation industry, one shaped by competition in technology, pricing strategies, and deepening market dependencies. To sum it up, China's directive to halt Boeing aircraft deliveries represents a staggering loss within the vast trade network between the two nations. Boeing's potential backlog in China includes over 1,000 aircraft, with an estimated value surpassing $150 billion, and when maintenance and parts contracts are included, that figure exceeds $200 billion. This makes China's latest move one of the most significant escalations in the ongoing trade conflict, threatening not just Boeing's immediate earnings but also its long-term business prospects and relationships. Unless the U.S. government alters its approach in the near future, Boeing's share price is likely to remain volatile, with a projected drop in market capitalization of up to $50 billion no longer sounding far-fetched. Beyond Wall Street, the ripple effects could extend to thousands of suppliers in Boeing's ecosystem and millions of workers and families tied to those supply chains. Some interpret these developments as strategic diplomacy by Beijing. There's always the possibility that China could eventually resume partial deliveries. But as it stands, the direction of U.S.-China relations doesn't inspire much optimism. The civil aviation sector, once considered relatively immune to geopolitical retaliation, has now become one of the main battlegrounds, underscoring just how far global economic tensions have advanced. Driven by the rhetoric of national security and strategic interests, protectionism and economic nationalism are on the rise. Global firms like Boeing find themselves stuck in the middle. Boeing is now the most visible example of the widening gap between Washington and Beijing, facing the risk of losing one of its most lucrative markets. The big question is, how does this end? Some experts predict that eventually, both sides will return to the negotiating table to safeguard key industries. If no such compromise is reached, the Boeing crisis could deepen further, potentially triggering new rounds of retaliation. For instance, if China decides to restrict imports of other essential American goods, the trade war would only intensify, and concerns about a global recession would become even more pronounced. Given so much uncertainty, investors are left questioning whether to hold on to hope for a diplomatic resolution or to prepare for more shocks ahead. That's why Boeing's stock remains highly volatile. Civil aviation has effectively become a geopolitical pressure point. Market commentary is increasingly focused on this shift. After all, China's suspension of Boeing deliveries isn't just about canceling 100, 200, or even 300 airplanes. It's about the billions of dollars tied up in aviation technology, supply networks, and diplomatic maneuvering. By the numbers, the situation places Boeing's projected annual revenue from China worth upwards of $10 billion at risk. It also threatens long-term business valued at $150 billion or more and could potentially trigger a stock market loss exceeding $50 billion. For the U.S. economy, losing access to a market that accounts for 15 to 20% of aviation exports is no small setback, and the fallout might not stop with civil aviation. Similar retaliatory actions could target other vital sectors in the near future. A new front in the trade war appears to have opened, with the Boeing affair serving as a stark reminder of how intense and unpredictable these economic conflicts can become. At this point, neither side seems willing to make concessions. China appears to be playing what it sees as a strong card in response to American tariffs. Meanwhile, the Trump administration insists, China walked away from the Boeing deal. We won't blink. Who's to say that behind the scenes a back channel isn't already being discussed, or that specific exceptions for Boeing won't be negotiated down the line? But for diplomacy to truly move forward, both countries must reach a point where the cost of inaction becomes too great. If that breaking point hasn't arrived yet, the standoff could drag on. Businesses, logistics networks, and workers are left hanging in the balance. A single company now risks losing up to $150 billion in future contracts, all because of rising tensions between the world's two largest economies. The aviation sector is becoming an arena for strategic maneuvering like never before. And with every passing day, the potential for further escalation remains. What happens next? We'll just have to wait and see.